The Hedgeless Horseman here. It's September the 22nd, 2025. First of all, thanks to the sponsors. Gold is going up. Silver is going up as well. Crypto is tanking. Markets are going up. Overall, a very good, good day if we're talking paper gains in a lot of junior portfolios. Obviously, a lot of people are very excited when they see stuff going up. It's kind of funny. It's like maybe it's because I slept so bad today. I'm not that excited, because the thing is, maybe that's I don't know, just an impulse from me, because I'm used to, or I should say, when it's hard to buy, when something is difficult, when it requires patience, etc., then I feel like, okay, now I'm whatever, better than Mr. Market. Now I'm doing something smart. Now I do something that actually requires fortitude and common sense and patience. When stuff is just going up and you see, Tom, Dick, and Harry basically making money and pumping the shit out of everything, it's simply not hard anymore. We're having some really, easy gains. Right now, stuff is just going up, and again, it's not, if think it's a lot of or a lot more to it than sentiment, you would be wrong. I mean, gold is up $270 since April, but you know as well as I do that GDXJ, gold juniors, they're up much more than, on average, they're up much more than 7%, or even 3 times that. 22%, 3x leverage. No, they're up, I don't know, 30 times that. They're up 100, 200, 300, 400%. And that's sentiment, because the businesses haven't changed that much. Gold price hasn't changed that much. The value of a gold mine hasn't changed that much. It's just gotten from extremely high to even higher. But now all of a sudden people care, and now all of a sudden we're starting to see uptrends form, and then everybody, comes into it, because now now you can make money in this sector. But I would say, I mean, the absolute most barn burner easy gains, they're already behind us. So that might also be one thing where it's like, compare it to the spring, when you're looking forward to summer. The whole summer is in store yet. So you think of all the potential, everything you could be doing in the summer, how fun it's gonna be, how much sun you're gonna get, how many times you're gonna go out to, let's say, clubs or pubs or whatever. So you have all of that in store. So you're looking forward to that. You're looking forward to unwrapping that present, and all of what's in that present is yet in store. Whereas, like, on the first day of July, for example, you're already, well, that's my experience at least, you're already starting to think about, or let's say mid-July. Now you're thinking like, oh my God, half the summer's already gone, and every day forward is getting closer to the end. There's more, there's more summer behind us than in front of us all of a sudden. So you start to think about, I'm not saying you should think like that, you should live in the moment. But I mean, as a very, let's say, forward-looking investor, which I think being forward-looking is obviously very, very good for an investor to be. But it also means you might, again, start to think about the end, then really enjoy the fact that it's the middle of summer, for example. So it might be something tied to that, which makes me like, yeah, I mean, I'm thinking of we're never gonna the buys we saw over the last year or so. I mean, we might not see buys like that except for specific companies, but sector overall for like 7 years or something. Who knows? Um, so yeah. I mean, portfolios are up. I'm happy to see the hodl portfolios. They're at all-time highs. That's the most fun actually when you make money for someone else. And I'm looking forward to telling some family members like, hey, you're up this much now. You can buy a house if you wanted to, I guess. Um, but yeah, I don't know what it is. I mean, I do enjoy the challenge. I do enjoy, let's say, needing to be right on the fundamentals, whereas now shit is starting to fly, which takes no skill, and basically just simply the more pumped story might get, the higher it goes. Uh, so yeah, we're getting into that territory where fundamentals, well, they didn't matter at the lows, but the better sentiment gets, it also works the opposite way. I mean, I much prefer a creeping bull market where there's not enough, let's say, exponential movement to get the greater fools too interested, in a sense, because then it's also not fundamentally driven, even though yes, all the cheap stuff, and there's still a lot of cheap stuff that should already be higher, so they should go up 100% today, for example, no questions asked, because they were that undervalued. But it's just the overall feel, let's say, of when stuff starts to trend, and you know people have no clue what they're doing, start to get into the sector, and of course people who take advantage of that, just to greater fool trading strategy. Because let's face it, I mean, and I just talked about this on K Report. Why are so many people excited today? I would say it's because most people have no idea, have no real cases for their holdings. They have no real idea why they should be making money in any junior, aka why they're actually undervalued. They don't have any idea what the news flow is going to be for the next 6 to 36 months, whatever it might be. Basically, the whole case is, I hope silver and gold goes higher, like everybody else, that I'm following on Twitter is saying. And if it goes high, I mean, a lot of people's cases are like, if silver goes to $100 or gold goes to 4,000. I mean, now gold is so high, so this was the blue sky prices just a year ago or something. But my point is that a lot of people's cases are simply that I have no real fundamental case for these juniors. I just think that, and everybody else says that if silver explodes, these juniors are gonna explode, and then I'm gonna make a bunch of money. So that's your only trigger. That's your only prerequisite, let's say, to make returns. I mean, that's. I hope you get what I'm saying. So that's why I think, and for me, compare that to, like, I'm excited about all my holdings for their fundamental reasons. I don't want. I mean, if and I would think you would agree that I'm not, that pumpy. I mean, I don't really sell anything I've talked about for, at least try to make it, let's say, a month before taking profits, even if it's up. So there's nothing in it for me to just pump, short-term pumping, because I'm not going to sell, so I can't really monetize it, and it's built on it's built on, that the news flow is gonna deliver. Typically, I mean, and some of the smaller, I mean, I own a bunch of companies maybe that I think, or a few at least, that I think simply can go a lot higher. And I might think that, yeah, I mean, this should do really well in good sentiment environment, but for better or for worse, I don't really, talk too much about them because I know they're more like greater fool trading, uh, or sentiment beta triggers for returns. So so basically, I'm excited about every specific company I own, what they could look like fundamentally, what they look like now or could look like within the next 3 years. So a higher gold price, higher sentiment, more, let's say, dumb money flooding into the sector was never really the case for returns. So I guess that's why I don't really care as much and don't really care about a day like this. And also when I see something, everything go up, or a lot of stuff go up, that just means the opportunity is going away as well. Unless there's some news out. If you own a junior that you thought was cheap and it goes up 10% today, that's slightly less risk reward going forward. There's a bit less upside, all else equal, if there was no news out. So yes, your portfolio gets a bump, but that means less expected future returns. So any money you put in will have lower returns from here on out, even though your portfolio grows. So yeah, maybe I'm too forward-looking in a sense that I'm already thinking, well, maybe I'm a glass half empty guy in that respect, because I think about the opportunities that are going away, and that the future expected returns are going lower by every day that this sector goes like this. And it's not, and that is, I don't know, feels worse than the actual paper returns I'm getting. So it just the fact that you make money on paper is not enough to offset the fact that opportunities are decreasing in future. The size of the future present is getting smaller. Maybe that's it. I don't know. Or maybe I just had a bad night's sleep. But I would also caution that when shit, shit flying is still shit. There's, vast majority of projects out there will never turn into mines. So it doesn't matter what silver, gold, copper, or nickel, or lithium, or whatever it is, it's going to be priced at, because they're not going to be mines in the next 20 years. So they will never benefit from the fact where the metals are trading today, or even tomorrow, or even 19 years from now. So that means, by definition, they will turn out to be trading sardines. And of course, again, a lot of people position in this sector, they only look at, and they can only really make money in a roaring bull. So they're like, hey, if I buy all these shit cows in a bull market, I can do really, really well. And you can outperform, let's say, a really good portfolio, or high quality portfolio. The flip side of that is, of course, that's a one-trick pony. If we go into considerable consolidation, or the bull market ends, or something like that, and they don't have any fundamentals, and they might be, I don't know, the next big move is a 75% drop, then you need timing, and you have no way of actually making any kind of money and not get destroyed in a bear market. So you don't have full cycle investing capabilities. Where I'm not never selling, well, I haven't sold out of this sector yet. I've been long for 10 years. And been done okay in bear markets as well. So I don't have really an obvious reason to get out of this sector, and that's good. Would you rather, is what I've been saying about crypto, the one trick ponies. If the only thing you know is crypto, or you only been in Bitcoin, So you made, let's say you're up 5,000% in Bitcoin, but you have no idea how to invest or anything like that. I mean, if Bitcoin is toast, you're toast, and you have no skills to actually make any money because you have never actually learned to invest. You just bet on something in a bull market and took incredible risk, and who knows, maybe at the end of the day Bitcoin is not worth much. So you're gonna revert back to your portfolio is gonna revert back to the intrinsic value of Bitcoin, which might be zero. So that's not a long term. Well, it's not a pretty picture long term at least. So I would just say that keep that in mind. Most projects out there are not great. I already know. I mean, there's one junior that's quite popular, and I would say that's. I don't comment often about other juniors, but I mean, a few I might have when I thought they were just somewhat outrageously or overvalued, relatively speaking, at least. Like when Founders Medal reached, I don't know what it was, 500 million or something. Whereas like other stuff around was trading a fourth of that or something and was less risky. That was, and it was a super hot stock at the time. And again, I mean, it was a super hot stock, so price kept moving up, but it was, in my opinion, overvalued. Not saying in an absolute terms, but in relative terms. And there's one exploration stock right now, which I think is one of the few that actually looks really overvalued, relatively speaking. But yeah, keep your calm, keep your composure. This might be. I mean, obviously, we're not really. I think we're trucking towards the end game, and the thing is, let's say gold rises to whatever price. And now, obviously, all deposits are making, or all mines, gold mines, are basically making a killing. But let's say we go up and up and up in gold price, and then we have some kind of revaluation, monetary reset, yada yada, and whatever the real margins on gold production, they get cut in half or something. If you have shitty projects, they'll go back to being really shitty projects. And if sentiment has peaked, I mean, all you have in store is big loss going forward, compared to if you buy something that's a really good project, really good deposit, really good mine, then it doesn't really matter that much. I mean, take Fruta del Norte for Lundin Gold. I don't know Lundin Gold, but that deposit is a tier 1 deposit, and it's going to make money in any realistic gold price environment. And since it's so high margin, it has less torque, of course. But the flip side is that, hey, even if gold fell by 50% tomorrow, that would still make money. There would be some value in that. It wouldn't get erased. Whereas you have some shitty mines or shitty projects that should never become mines. I mean, if gold fell by 50%, they might, lose money, and that company goes bankrupt. And of course, when I've been, during the weekend, I did some spreadsheets. I love to do spreadsheets, just theory crafting what I think the upside is, what the probability is, and I'm talking from a value perspective. Where it's like, okay, I think this developer, advanced explorer could grow by 200% in value, or basically, I think over the next 3 years they could create 200% of value or tangible value, and the stock should be up 200% without help of gold and silver. That's a story I'm excited about, because 200% in 3 years is great. Then all the extra upside from an even higher gold price, for example, might be gravy. And who knows, maybe the story is 100% undervalued today, and I think it could grow by 200%. So that's how you can have really, I should say like this, that my base case might be that I think some of these junior zone with, I think, good projects, good prospects. I think they could go up to 100% over the next 3 years from just value creation, just execution and tangible value creation. If sentiment gets really hot, I might need to double that or triple that. So if gold doesn't go higher, maybe they go up 200%, which is a great return, absolute great return. Maybe it's quite low risk as well. But if sentiment gets hotter and we reach euphoria, I mean, gold goes up $1,000 plus sentiment gets really hot. I mean, that 200% might turn into 800%. But that's not the requirements, that's the bonus. So I'm in a position where because I'm obviously bullish on gold and silver, but it's not a requirement. Whereas if I buy a producer and the case is that if silver goes to $100 and gold goes to $4,500, I'm gonna make 3x, whatever. Then it all comes down to what the gold price does, and hence what the margins are, and also add, the sentiment multiplier. I much rather prefer getting possibly 3 out of 3. The underlying value creation plus a higher metals price plus a better sentiment premium. Right? If that makes sense. So by aiming for, let's say, probable 200% returners over 3 years, I'm just making up a number here, I'm putting myself up to get maybe up to 10 baggers in relatively low risk stories. Whereas there's producers out there that might be closer to fair value, and they might go up a lot if silver goes to 100, if gold goes to whatever it does. But that's if that happens. If gold, silver goes down and sentiment decreases, they have no value creation. Those stocks are going to go down over 3 years. If gold and silver stays flat and sentiment stays flat, you'll stay flat. I hope maybe I should. Again, I mean, if let's say you have something that's worth this at today's gold price, so it's at fair value, and this is the whatever price boost from higher metal prices. Well, if I add a value creation curve as well, then if things go well, I might have made this much on the pure beta and this much on the, let's say, alpha plus beta. There's a higher delta here to here, of course, than here to here. And then, of course, you have the sentiment oscillator, let's say, that might add this much in positive sentiment. So this is the value creation, and then you slap on a premium. Or it might be poor sentiment, but value creation happened, and then you still make money. But in this case, where you're only betting on, let's say, a higher gold price, let's say the gold price goes down. Oh shit. Let's say the gold price goes down and you have decreasing sentiment. Then you're gonna be looking at a loss from here down to here. Whereas if you have value creation plus poor sentiment, you might at least still make money, because this is the delta, it's positive. Right? That's how I think about it. I want to stack the deck in my favor as much as possible, and I don't want it to only be I'm gonna make money if Joe Schmo buys into my companies, have no idea what he's doing, and is just full on greed mode. Plus, metals go up, but I need all that. So I need greater fools and a higher metals price. I would call that speculation. if you're right on the fundamentals, you're already setting yourself up to make money, even possibly in lower metal price, even with lower sentiment as well. Because let's face it, if a story is pretty cheap today, they have 1 million ounces, they have a good target, let's say, they drill up 3 million ounces over the next 3 years. If gold price is flat, that's probably going to be worth more, because it might have gone from a tier 4 project to a tier 2 project. Maybe they get whatever, $40 per ounce in the ground right now on their 1 million ounce, and then they would get $80 per ounce for the 3 million ounces. That's a multiplier, because it crossed the threshold to become a tier 2 deposit, one of the better ones around, for example. I hope that makes sense. So yeah, and I thought I have a friend actually who's pretty much all in Bitcoin, and you know, he's, I think, starting to look at, you know, well, he asked me, you know, is there any room left in you know, the gold mining sector and all that. I mean, he's obviously seen the headlines that gold is doing well, but it's like, if you ask me, am I like super enthusiastic of buying physical gold right now? It's like, well, after a run like this, as some form of a contrarian, it's not like I'm having FOMO what the gold price is doing. I'm having FOMO. I think I'm at very high rational greed levels when it comes to the gold juniors, because I think they are stupid cheap. I think most gold juniors are still cheaper than the silver juniors, and I can't really explain it why, but I mean, you have, you know, silver juniors, when they're looking to, most of them, I mean, they would be happy to cross like 100 million ounces of silver. That's a big thing, and all of a sudden they're in quite rare company, because there are not that many. And to be fair as well, I mean, most of those ounces are typically not silver. It might be 50%, so it's actually more like 5 million ounces of silver. And then compare that to what the gold ratio is. It's like 1 million ounces of, or 100 million ounces of AG equivalent is almost the same as 1 million ounces of AU equivalent of gold. How many people do you see excited about a 1 million ounce gold deposit? Not many, right? But 100 million silver is like, oh geez, you have 100. It's like, wow, that doesn't say much. I mean, that's doesn't mean much. I mean, if I look at BlackRock Silver, for example, one of few silver juniors, advanced explorers, I actually like. Why? Because they have a high grade project that could be a really good deposit. So they could be making a lot of money on that, even if it, you know, whatever was gold equivalent, or it's still high grade, right? But a lot of the silver, I think a lot of silver deposits, they're not majority silver, or maybe they are barely majority silver. They're not that high grade, and it's not that many ounces. So that's why I still favor the, you know, what gold plays. But the thing is that silver has a tendency then that when there's a real bull market in precious metals, silver tends to at the end outperform gold, and it can just shoot up to the sky for a brief period, because it is more speculative. So it's like many of these silver juniors have a speculative premium baked in, which I don't like. And there's only a few that I think have actually good projects that are not overvalued on their fundamentals. And of course, a lot of silver projects are crap projects that will never become mines, and still, you know, oh, they're selling for this cheap in silver per ounce in the ground. And of course, that same goes for gold. But anyway, so my friend and I thought, it's like, okay, I'm just gonna make, you know, a theoretical portfolio here. I'm not sure I own all of these names, but I was just thinking that, okay, how do I you know, come up with a portfolio that's like, I'm not gonna say 100%, I'm very, very confident will do very well if there was no trades happening. Kind of like the third-party validated portfolio, which I think is up around 200% now, and that didn't. I mean, some companies I just picked because hey, I mean, I looked into the presentation, they have a major involved, so you know there's some upside, yada yada. But one second. But so I thought it's okay if I gave someone, let's say somebody has $100,000, uh, they like to get into the junior mining space. They think it's gonna go up, yada yada, and I would just okay, here I'm gonna give you a portfolio. You're gonna buy all these names, hold them for 5 years, and I would be surprised if you don't outperform GDXJ. You're probably gonna make money if gold stays flat. You might make money if gold goes down. You'll make a lot of money if gold goes up and sentiment goes up. And I'm, on average right on these cases that they are actually fundamentally good cases, which with fundamental upside. And some, I mean, this is not even gold and silver, but so I think, what the hell happened here? I think the computer froze. But I think this portfolio, for example, would do very well. And you get a bit of everything. Emphasis on advanced gold projects, and some high risk but really cheap ones that I think have could, without the price of metals helping, could 5, 10, 20, 30x plus. And a lot of them are again advanced. They're closer to or in the second part of the Lassonde curve, yada yada yada. And then some advanced explorers, and you get some copper. It's like Lundin backed Faraday, for example. Here you get uranium and polymetallic in district, Stillwater, a lot of polymetallic, nickel, copper, critical minerals, etc. So I thought about, now I should have already, well, maybe I can look at what the closing prices was, because I thought about doing just this example portfolio and then come back again in like 2 years or something, and I would expect this to be up quite a bit. And I guess that's also a point. That is like, okay, I put this list together, took me maybe 20 minutes or something. So by the sound of it, it's like, well, how can you make money on something you came up with in, let's say, 20 minutes? And what's the difference of somebody just jumping in this jumping in this sector, and it's like, I'm just gonna buy whatever it is, 30 juniors, and I should do well. Should do well as anybody else who has 30 juniors. But at the same time, I mean, a lot of obviously it's like 10 years of experience in the junior sector, and knowing most of these companies, somewhat well, at least, they've come up with this list. So I honestly think, for example, this would be a kick-ass portfolio. Emphasis on the low risk side. I mean, you could say that, well, Newmont and Agnico are low risk. Like, yeah, sure, but Newmont and Agnico don't have inherent, let's say, 3x potential over the next 3 years without the help of gold price. So any one case is a higher chance of losing money, but they all have much, much more fundamental upside than the quote lower risk story. So on average, I think the risk reward is much better in a portfolio like this, for example. Anyway, I thought I would just throw it out there. This is not buy or sell recommendations, but I mean, this is probably how. Again, I only spent 20 minutes on this, but this is sorta how if I just told someone, or if somebody said, hey, give me a list of juniors to, again, not buying recommendation here, but this is one I could send to my friend, for example, and just say, buy these juniors, sit on them for 5 years, higher weighting up here, lower weighting here, lowest weighting here, to keep it as low risk as possible, and you should do very, very well, if I had to guess. And of course, again, that's 10 years of junior experience and investing experience that gets into a list you can make in 20 minutes, and I think it's superior to GDXJ and GDX, etc. Anyway, let's look at some news. I recently did the K report, and I talked about this company here. I've participated in 2 placements of New Break Resources. One of those high risk, high reward stories. It was simply they were looking for a young Davidson analog, and high risk, high reward. It was like, what are the odds of there being a significant deposit within the project, and if it is, what are the odds that they're gonna hit it anytime soon? How many rounds of dilution do you need? I mean, even if they hit it something and made a discovery 2-3 years from now, I mean, that might be X amount of dilution rounds, plus there's no guarantee they will actually discover something, make even a discovery hole. And I've been holding this for maybe a year, and all of a sudden they came out with these very good looking discovery holes. And what I mean by that, I'm not saying that this is 100% guaranteed discovery, but these are, I mean, if somebody asks you what kind of, on their maiden drill campaign, what are your realistic blue sky scenario? It would be to come out with holes like this, because it kind of reminds you of somewhat of a young Davidson, wide widths. This is even higher grade than young Davidson, but young Davidson can have even higher widths. It's like almost like Barcelona, 50 to 100 meters. But point is, statistically, these are extremely impressive results. If you look at the Kennerland study, I think somebody calculated the where was it? Somebody calculated the full intro. Where the hell was that? Yeah, here. So it was engineer. Hole 5 combined, that's 153 gram meters. I think that is above the threshold in the Kennerland study, where it's like, if a company drills 143, I think, gram meter within less than 10,000 meters of drilling, that's can be highly significant, and that's that could mean there's a 5 million ounce deposit. So they drilled that within the first, I think, 2,000 meters. So again, just statistically speaking, all else equal, and I don't think these are twinned holes or anything like that. It seems to be legit, first drill assays from that target. So statistically extremely impressive, because the idea is that either they were really, really lucky, or this is a very robust system they hit, which can produce grades like this without needing to be that lucky. And then, of course, the stock popped on that around 100% or something. And I have all my shares still, and I have some warrants as well. But I actually added some. I took first position for some of the family members, because like I've been saying, and I'm gonna do a video on that as well, how you play higher reward plays. that you can't really take the high risk, because let's face it, what were the odds that they were going to have results like this? I don't know, 5%, 10%, I don't know, nobody knows. But now all of a sudden, when you have results like this, it increases the chance that you will find an economically significant deposit by a lot. So now maybe there's a 20% chance you're gonna find something worth 500 million. All of a sudden, that's an expected value of 100 million. So the risk went down a lot, and the chance of success increased a lot. And yes, the market cap went up as well. But at 20 million market cap, obviously there's a lot of room for upside. I mean, if you would find a new Young Davidson, that would be worth, let's say, a couple billions today. That's going to take time. That's going to take dilution. But that's the idea. So I cannot afford to, have these high risk, high reward plays. And the ones that make a discovery hole, I'm selling out at 100%. Because let's say 1 in 10 of these kind of punts make a discovery hole. And 1 in 10 actually ends up making a significant discovery from that discovery hole. If I only have one that's going to do that in 10 names, let's say the other 9 go down 50%. If I sell out at 100% return, let's say, that's not going to pay for the 9 losers. But if a story like this, it goes up 100%, and that's still the start, then it goes up 10x more to 200 million. And I mean, if we're taking it all the way to a really significant discovery, obviously we could be talking, in a few years about a theoretical $1 billion company. Then that would pay for all the other 9. But the risk you're taking determines how much reward you have to get from the few that become successes. And we don't know if this is going to be a full-blown success yet, but this is a good start. This is, this is what you would like to see for a reward story, or for a potential reward story. And I didn't take a huge position, and it's still not a huge position. If this ends up going down 50% from here, or even more, that's not going to kill my portfolio. But if this goes up 10x more, that's going to have, a okay impact on the portfolio all of a sudden. And the odds of this having it has a higher chance of doubling after it has doubled than it has doubling before the discovery. That means lower risk. Yes, less absolute upside. But I hope you get my point. That's why, even though it feels like, and I used to do that myself, I think in the early days when I bet too big on pre-discovery plays. I thought it was always a 50% chance that they will make a discovery on their very first holes. Statistically speaking, that did not happen. And I think my idea was that, okay, I'm going to take big positions in pre-discovery plays because I thought that's how you get a 10-bagger. And to be honest, when some actually succeed in making a discovery hole, I probably thought, okay, great, now I have 100%, so now I'm going to sell. And again, if you do that enough times, if you play high reward, high risk, high reward, stuff like that, you're gonna you're gonna lose money long term. It's often better risk reward buying after something is up 100% on a discovery hole than before it's up. And then, since it's less risk, assuming that this has a higher chance of finding something, let's say worth 500 million after the discovery hole than before the discovery hole, that means you can accept less reward because you don't take as much risk. Let's say 1 in 4 discoveries with a discovery hole like this turn into whatever 10 bagger. I mean, that's gonna that four case portfolio is gonna be positive if you hold it up until that. But if you sell that at 100% gain, that's also one case where you're not gonna make you're gonna lose less than if you did the pre-discovery play and had 10 names and one succeeded, where 90% of your portfolio went down 50% instead of 75% of your portfolio went down 50%, but it's still a money losing strategy. Finex put out news. They also say that first assays are expected late October or November, and it's funny, it just reminds me how goddamn impatient I can be. That it feels like an eternity, a month to wait for initial assays, and the immediate thought is like, well, I can, there's always some company with assays that might be expected in 2 weeks or something like that. It's just funny how even though I think I'm relatively speaking, I'm more patient than most, but it's funny but it also goes with how excited you are about something, right? Since this is the purest definition of a high risk, high reward story, initial maiden campaign, that means, it's very exciting, because these first holes are in the short term gonna absolutely make or break the case. In the short term, they have more projects, so long term it's not a breaker, but it could make this story super boring and have it minus 50%, let's say, if the assets are shit. But it could also be a company maker, because we know that the mineralization is scattered along. Do they have the old trenches? No, okay, they don't have the old trenches. I think they're around here. So we know there's, veining across, how long were the trenches? I don't remember. But it's kind of, all intents and purposes, I consider this a bulk type target, where you have a bunch of veins making up a bulk target. So if we look at the scale here, that's 200 meters. So maybe, and this was a new trench which they drilled under, so I'm assuming this looks good as well. I'm not 100% sure how close this is to the old trenches, but let's say, what's the distance here? Let's say 200 meters, now 400 meters strike, and they're testing. They have holes here, going there. So if this is a bulk type system where you have all these veins, kind of like, almost like a reduced intrusion type related gold system, this is some serious scale if they would end up, let's say, hitting. If they show, I don't know, I'm just making numbers up now, but let's say they, at 200 meters to 1 gram per ton, or it would be great also if they found something like, 30 meters of 2 grams per ton, etc. My point is that, like Racklar's current drilling, it's not as, I'd assume it's not as explosive as Racklar's, because they're drilling up a much larger tonnage. But here obviously have a much lower threshold for success. If you find 1 million ounces of good grade here, that's going to be a satellite deposit for Kittilä, I'm pretty sure. So pretty low threshold because Kittilä is around, and also high potential value because it's in Finland, appears to be starting near surface, and if the grade and tonnage delivers, etc. This is in short, this is a very good looking target. And here you also have that possibility where it's like, it's Schrodinger's cat. We don't know what's going to come out of this. if we just look at how big of a footprint they have drilled, and if we look at Blue Sky, where it's like, yes, this is a bulk mineable, bulk type system, there will be economic grades, and they will hit it, good grades and widths over most of this footprint. The Blue Sky is that they de-risk an incredible amount of value in short order just with this first drill campaign, and basically again almost making a company maker just from the maiden drill campaign. Is that a guarantee? No, but it's also creating a 20 million market cap, so it's kind of like new break in the sense that there's upside because how much is priced in. This is not pricing in 1 million ounces of economic gold, or the idea that, hey, who knows if it's really good, that we could already be looking at 2 million ounces of economic gold. So that is the risk, is that there will be no economic gold or something. The results are so poor that it makes 23 million market cap look expensive. That's a risk. And of course, assuming these holes are good and Finex goes up 100% to 40, maybe depending on the assay, depending on the assays, maybe they're so good that at least one can say, okay, there's probably, let's say, $500 million of value here after a main drill campaign, or there's like whatever 50% chance that there's going to be at least 500 million worth of gold project worth 500 million. That's 250 million in expected value, and if this doubles, that's only at 45 million CAD. So again, that might be even. There's for sure a possibility where, I'm long this now, so I think the risk reward is good enough, obviously. But who knows? Maybe when assays are out and Finex theoretically is up 100%, that might be a much better buy than Finex is now, and I already think it's a buy now. But obviously it's higher risk. But when the results are out, risk might go down considerably. If we're again talking, what are the chances that they're gonna find something worth 500 million right now? If that's 10%, that's worth, rule of thumb, expected value, that's worth 50 million. So then it's 50% undervalued right now. But if it goes up to 50% post assays, that's worth 250, and a double from here would have it at around almost 50 million. So that would still need to 5x after it's gone up 100% to price in the new chance of success of it being worth 500 million. So again, theoretically, there is a possibility where this is worth, should be, could be seen as being worth 100% more than the current market cap right now. But if that happens post assay risk, it might be even more undervalued than from a risk reward basis. Red Canyon also announced, maybe I talked about this, but so Red Canyon has tech mining get into it. Let's see. Tech resources, $26 billion. So how much do you need to know about geology or mining, for example, to think that, hey, Red Canyon might be worth a punt in a, relatively small position, high risk portion of the portfolio? Well, it's now at 15 million CAD. Tech has a $26 billion market cap. How much would they need? What are they looking for? What moves the needle for them? Pretty much a tier 1 discovery of some kind, right? What's priced in? What chance of success right now is priced in that this phase 2, let's say, drilling going into Kendall Ridge is going to bring visibility of there being an actual deposit worth mining here? Not much, right? That this is 10% of 150 million or 1% of 1.5 billion. And I would say 1.5 billion is probably the scale that tech would need to see. Am I saying that this is gonna, if they hit, it's proven that they have $1.5 billion worth? No, I'm just saying that if you ran these scenarios out, if you had Red Canyon, for example, in your portfolio and you were never gonna sell, let's give them 5 years, Red Canyon, it's not pricing in, you're getting great odds in a sense that a tech could be, there could be a 10% chance that they find something worth what tech is looking for. Let's say 10% chance, 90% chance of failure, 90% chance that you'll, let's say, lose 50%. But there's a 10% chance that in 5 years they will have proven something up which is big enough for tech. Then you know that 1 in 10 times this market cap is going to be orders of magnitude higher, right? Is that something to go all in on? Obviously not, because it's still high risk, high reward story. Does it make sense if you could have 100 Red Canyons? Knowing this, I would say so. It would make sense to, you can make a portfolio of just 100 different Red Canyons at 1% each. Because 10, let's say, would make discoveries, and 10 of them then would go up from this market cap, let's say, 30 times. Right? And you need 900% to have the portfolio break even, and then so basically 200%. But 10 10 out of those 100 stories would go up so much that your initial investment was up 200% within 5 years. Is that, that's a great risk-adjusted return. If you assume, well, 5 years is a long time, well, somewhat a long time. I mean, but if it's 15%, that changes things a lot already. If it's 20%, changes it even more, right? I just have a hard time seeing that tech would fund any junior if they thought, well, this is probably accurate, and we see there's a 1% chance that a system like Kendall can deliver a porphyry deposit worth mining. The footprint near surface, the infrastructure, I mean, the threshold for success is low for a porphyry deposit even. I hope you get my point. So, but that's also the difference between, I think Red Canyon is one no-brainer out of a high-risk, high-reward portfolio, and a no-brainer might mean that, yes, Red Canyon should make up 1% of your portfolio, whereas like a low-risk no-brainer might be worth to have 10%, 20%. That's the difference. It comes down to the risk. How much do you need to diversify away the risk? If I made a portfolio of 100 Red Canyons, I think that portfolio would be great and not even that high risk. But if you made a portfolio of 10 low risk juniors with expected 200% upside, maybe the expected return on those two portfolios might be exactly the same. One comes out of 100 names with high risk, high reward profiles, and the other one comes out of 10 names with low risk, medium reward profiles. Gambling obviously is that if you find stories like this and you think, well, if this works out and I had 50% of my portfolio in it, I could 10x my portfolio in 2 years without help of gold or copper going up. But why is that gambling? Because if you only have 2 such stories, and on average you need 10 for one to work out, that is the definition of gambling. Because on average you're not going to have any of the 2, on average your portfolio is not going to have a success case if the chance of success is 10% and you have 2 names. You need 10 to on average have 1 success. You need 20 to increase that even further, yada yada. I hope you get my point. So there's a huge difference in sizing between a high risk, high reward no-brainer and a low risk, medium reward no-brainer. I guess that's about it. I really didn't have that much to. I didn't have a really good script to follow, so it just rants as usual. But yeah, I guess the takeaway is that I'm just reflecting from my side of the, or from my investing perspective, that I'm excited about the companies. So when I'm let's say greedily buying or holding the juniors I have, the win condition is not that gold and silver is going to go to $100 and gold is going to go to $5,000, and that's how I make my money. And then also I need dumb money to just push my crap higher. So that's why days like this, when you see sentiment, etc., go up and gold go up, I mean, it's a nice bonus and all that, but it's not. My portfolio is not based on it, and maybe that's why I don't care too much, or am not as cheerful as a lot of people who their win condition they have in their mind is that, again, they don't really know what they're doing and they just need somebody else to buy them higher, and they might be holding crap companies without good fundamentals, and the actual expected value of those companies is going to be lower if because whatever management team is poor, the projects are crap and are probably not going to go anywhere. So the more so they need greater fools, let's say, to bail them out, and nothing gets greater fools going as higher gold and silver prices, which affects the juniors sooner or later, which creates an upturn, and that's going to get people to buy, but has nothing really to do what the actual news flow is from the companies or what their projects are worth or anything like that. Anyway, thanks for listening. Consider me biased. I own shares of probably every company I mentioned. Some are banner sponsors, double biased. Not investing advice. Don't invest money you cannot afford to lose. Assume I might buy or sell any store at any point in time. So again, if you think you're my exit liquidity, don't buy it. You have to make up your own mind, see the case for yourself. You know your risk profile, your yada yada. So if you don't know why you own a gold junior or any junior, any investment, you shouldn't buy it, because you're gonna end up making mistakes. If I give you the best or if somebody gives me the best possible junior case out there, and I don't have conviction and I don't see the case, I'm probably gonna end up maybe losing money on that. But if I'm gonna make more, I think, on a good case that I have a lot of conviction in, a good store that I have a lot of conviction in, know why I own it, know why I would sell it, than I would if I had no conviction but a great case, because I would probably end up selling the great case too early or in a correction, whereas like the good case that I have conviction is, I'm gonna be riding it, being able to ride it, and being able to buy it instead of selling if it corrects. Thanks for listening. Bye.